Okay, fabulous. So let's go ahead and get started. As I said, my name is Kathy Lien, and I'm managing partner of BKForex Advisors as well as director of currency research for GFT. And this morning I'm very excited to be here with you because we've got quite a bit of volatility in the euro dollar, and I was looking a little bit into what Derek was talking about. I know there are a lot of questions about the euro, so it's extremely timely that I'm holding a special session on how to trade the euro, and I'm quite excited about this because this is a relatively new presentation I put together, and I hope you will learn a lot from it, and I hope you will enjoy it. Okay, now before I begin, I'm obliged to show you this disclaimer, which basically says that trading currencies can be risky. You can make money, you can lose money, so it's very, very important to know what you're doing and be aware of all of the risks. Okay, so what are we going to talk about today? Well, we're going to talk about a lot. We're going to start off and we're going to talk a little bit about the nuances of trading the euro. Then we're going to talk about what is driving euro movements fundamentally these days. The good and the bad in the Eurozone. I don't even know what I wrote here. What's a chance? I think that's what to trade. And ways to trade. And we're going to share a little bit of a, depending upon how much time we'll have, I'll share 1 to 2 euro trading strategies. And if you will bear with me afterwards, I'll talk a little bit about what we do at BK. Now, for those of you that are BK members, I'm sure that you received our euro trade this morning, which allowed us to ride the comments from Bernanke, and we, thanks to Mr. Bernanke, we were able to bank some tippage off of that, so we're quite excited. Okay, in terms of the euro, what you need to know. Well, there's a lot of unique characteristics about trading the euro that make it so interesting for traders around the world, and why most of us, when we come to these sessions, our main question is centered around the euro. The reason for that is because the euro is the most liquid currency in the world. It is the most actively traded currency. Bank of International Settlements releases its volume reports on a regular basis, and if you take a look at this, you'll see that the majority of currency traders start with the euro dollar, and they're interested in the euro dollar. Now, the reason for that is because its liquidity creates an environment where the spreads are usually tighter, and when the spreads are usually tighter, the transaction costs are a little lower. And with all these different currency pairs that brokers offer, from 20 to 200, a good place to start tends to be the most liquid and most covered currency in the world, the currency pair in the world, and that's the euro dollar. Now, the most important thing that you should remember about the euro dollar is that it is a currency for 17 different countries. That's a good thing, that's a bad thing. Unfortunately, these days, it is the source of the euro's troubles. And it is one of the main reasons why, throughout the past decade, the British were adamantly opposed to joining the euro, because maybe in their crystal ball, they saw that these would be the consequences of being part of the Eurozone, which if the UK adopted the euro, they would be in just as bad of a situation and be forced, rather than just asked to put up some money to save the Eurozone and the weaker members of the region. Now, in terms of trading the euro, as we saw today, the euro moves on both U.S. and Eurozone development. So what I was going to say is that, as you saw today, how the euro moves is dependent upon both U.S. and Eurozone development. For a very long time, the euro dollar was considered the anti-dollar. And this was the case, I would say, even about a couple of weeks ago, where the euro dollar traded, once we had Greece default, and we had the CDS spread launched, and we had the CDS default, and then we also had payments triggered. We saw the impact or the driver market movement shift from the Greek saga over to U.S. monetary policy and U.S. development. That's when the dollar was rising in both good and bad news, because there was a very consistent improvement in U.S. Fundamentals, meaning the U.S. economy. We saw very consistent improvements in the U.S. labor market. We also saw very consistent improvements, in terms of, many other aspects of the economy. So the dollar started to rise, and that drove, euro dollar lower. But when we had a little bit of risk aversion, we also saw the dollar, benefit from that. But today, what we're seeing is that all of the optimism that was centered in the dollar, which had driven bond yields higher, which has driven the greenback higher, is evaporating. And the reason for that is because, we had the Federal Reserve acknowledge all the improvements in the U.S. economy according to the last FOMC statement, and it sounded like they really didn't want to or felt the need to add another round of quantitative easing. But today, this morning, Bernanke was pretty crystal clear. If you read my report this morning or the note that I put out, or you follow my Twitter, you'll see that I said that the number of times that Bernanke used the word accommodative, it was a very strong sign to us that QE3 is still on the table. In terms of the level of unemployment, it's declined, but it's not declining at a fast enough pace for the Federal Reserve to eliminate the need for more stimulus. Bernanke really felt that in order to change the economy from recovery to growth, they really felt the need to add or keep monetary policy easy. That was the only way that they could bring the economy from the recovery mode over to a growth mode. And they also weren't sure if the improvements in the unemployment rate was going to last. So all of that basically left QE on the table, as Nancy said, and that drove the U.S. dollar sharply lower because everyone had to readjust their interest rate expectations. They went from no QE to more QE, and typically when we have this type of scenario, it usually leads to a reaction in the euro dollar that lasts, or the dollar specifically that lasts. It's not just a one-day reaction. Typically, it's a series of reactions, because I think that this message will be one that will be reinforced by Federal Reserve officials in the days to come. And the more consistency we hear from Federal Reserve officials, where they do say, yes, we're worried, that could really hurt the dollar and really cause U.S. yields to compress and reverse some of the gains that we had in the greenback, particularly against the Japanese yen. So that's the dollar in general. What we're focused on today is the euro. In terms of Europe, there's a couple of things that, we have to pay attention to, and I'll show you how the Eurozone economy is doing in just a second. But we've got something that's rather unique about the euro dollar, which, as I said, it trades on both U.S. as well as Eurozone development. So there's two very unique characteristics of the dollar. It's either considered a risk-on trade or risk-off trade for the most part. So when it comes to Eurodollar, we have weak U.S. data. It actually can be more hurtful for the Eurodollar than helpful, because sometimes in those cases you'll have people worried about how it impacts the Eurozone economy as well as the U.S. economy. So one of the tips I always give for currency traders is that when it comes to trading non-farm payrolls, the Eurodollar is like the worst currency to trade NFPs. We all know that NFPs can be extremely, extremely volatile, but it's much better to trade NFPs through something that's a little bit, has a little bit more of a direct correlation with how the U.S. economy is doing and just the U.S. in general, and that would be dollar yen. So when it comes to U.S. economic data, what I prefer to do is I prefer to trade dollar yen versus the euro dollar. But because the euro dollar, oftentimes, let's say we have a really strong non-farm payrolls report, what you may initially see is the euro dollar will initially decline because a strong NFP report will drive the U.S. dollar higher against the euro. But then what will happen shortly thereafter, particularly when the U.S. stock market starts to open, is that then risk appetite starts to turn positive. You see stocks rally and, investors get a little excited, and that's when they start to buy euros, and you get a nice little, we call the V-shaped reversal. So when it comes to trading the euro dollar, I think risk appetite is much more important than economic data when it comes to U.S. economic data. But Eurozone economic data is important. And that's why, this shows you how the Eurozone economy has been performing as of late. One of the big stories last week was the major disappointment that we had in Eurozone PMI numbers. This little chart here, or this little image here, shows you that from a growth perspective, we have seen deterioration in both service and manufacturing activity. If you actually take a look at the PMI numbers, both service and manufacturing activity is contracting in the Eurozone. And there's a great fear that because both of these numbers are below 50, that could basically point to the fact that we may have another quarter of negative GDP growth in the Eurozone, which would put Europe in a quote-unquote technical recession. So that is obviously very bad for the euro. And also we saw German producer prices released earlier this month, and even though we had oil prices on the rise, we don't have too much of an uptick in producer price growth. So on the one hand, you have Eurozone growth slowing. On the other hand, you have inflationary pressures. It's relatively steady and actually, growing at a slower pace. So for the ECB, this is not good news. This is actually, terrible news, which is why this morning we had ECB member Weber and we also had ECB member Neuer, make comments that allude to the fact that, maybe the ECB is also thinking about more quantitative easing or another long-term refinancing operation, LTRO for short. So that's the main thing that could halt the euro-dollar rally basically halt the euro-dollar rally. It's if we do see any sort of fresh dovishness from the ECB, from ECB member Draghi. This is second image shows you that aside from the PMI numbers and inflationary numbers, you can also see at the very top of here that German retail sales, the last release that we got, plunged. They were terrible. It was horrid. Also, German factory orders fell 2.7%. Industrial production increased a little, service sector increased a little in February, but we have the March numbers, so that's really what we care about. Overall, these numbers tell us that the Eurozone economy is slowing. And unfortunately, the prospect for the Eurozone economy remains very bad, because if you think about all of the countries that need to implement austerity measures this year, including including Germany, which is the strongest and the largest country in the Eurozone. They're talking about how they need to tighten the belt, how they need to cut spending. That would only lead to weaker growth in the Eurozone. So when faced with weaker growth in an environment of higher commodity prices, what can central banks do? Well, in terms of the ECB, one of the main options is the LTRO. Last Wednesday was the 3-month birthday of the ECB's long-term refinancing operation. In terms of the LTRO, it was, to sum it up, it was ECB President Mario Draghi's initiative to lend to Eurozone banks more than 1 trillion euros in very cheap loans at around 1% for up to 3 years. And there's no doubt that the impact of the LTRO program has been significant. It has reduced the European sovereign debt risk. It has prevented a crash following the Greek crisis, and it has kept banks buying. Basically, European banks are parking the collateral with the ECB, and they're taking that money and they're buying and they're investing in quote-unquote riskier assets, such as Spanish bonds, Italian bonds. So we can say that to a large degree, the ECB LTRO program has been successful in reducing the risk in the Eurozone. But what it has also done is it has also made banks reliant on the ECB. So without these cheap loans from the ECB, we could be in a situation that if the LTRO ends or the ECB doesn't follow up with more LTRO, that we could possibly see, Spanish and Italian bond yields just kind of pop higher, because it's really the ECB's continuous line of cheap money that's keeping demand for Spanish and Italian bonds steady. So when investors and banks are buying Spanish and Italian bonds, that keeps the yield from rising. So this chart just basically shows you how much banks have been putting up, how much money they've been putting up in overnight deposits to the ECB, and basically taking some of the cheap money and later on buying more risky assets. And the ultra easy monetary policy and the abundance of cheap money in the market is exactly what has fueled the strong rally that we have seen in stock markets around the world, including the German DAX, which you can see in this chart here, has had a really nice rally that began with the Federal Reserve's quantitative easing program in 2010 and just kind of extended beyond that, and was kind of exacerbated by the ECB's LTRO program. Same story with the Nasdaq. The Nasdaq is up about 21%, and that's basically since the December 21 LTRO program. So that too has been a huge boost for both the U.S. as well as European markets. So this is part of the reason why investors have responded so positively to Bernanke's comments today, because the prospect of more stimulus is good for stocks. So one of the immediate things that we realized that was going to happen as soon as Bernanke opened his mouth and said, maybe more accommodative policy is needed, was that it was going to be really good for the stock market and reverse the weakness that we saw towards the end of last week. So what has ECB President Draghi been saying? Well, some of the recent comments that he has had is that even though the markets have stabilized as a result of the Greek default, the worst is over, but there are still risks, according to ECB Draghi. The situation is stabilizing, but if the inflation outlook were to deteriorate, the ECB stands ready to act immediately and preventively. So the ECB is telling us that right now they're somewhat satisfied with the situation, but they're watching the markets very, very carefully because there's still quite a bit of risk, particularly with Spain and Italy. And one of the main and only reasons why they haven't pulled the trigger on more stimulus is because there is some upside risk in inflation caused by higher commodity prices. But if inflation was to start trickling lower, they stand ready to act immediately to increase stimulus if necessary. So in terms of the good and the bad, first of all, what has been helping the euro is that, number one, risk appetite is holding steady thanks to the rally in equities. It is also benefiting from the latest comments from Bernanke, who's saying that the U.S. may engage in another round of quantitative easing, and it's also benefiting from the fact that the Greek crisis, for the most part, is behind us. The bad and what could temper the rally in the euro dollar is that economic data has taken a turn for the worse. If we start to see more bad news, and we like to say that usually, bad news begets more bad news. If we have, more weakness in Eurozone economic data, that could renew speculation of the ECB doing more stimulus. So as I wrote in my notes this morning, that the fate of the euro dollar lies in which central bank acts first to increase stimulus. If we get into a situation where it seems like the ECB will increase stimulus sooner than the Federal Reserve, that could be more euro bearish and, pull the euro lower. But if the Federal Reserve seems to be more likely to increase stimulus sooner than the ECB, then the euro dollar could rally. And based upon how the economy is doing, based upon what central bankers are saying, I think that there's a very good chance the ECB could act before the Federal Reserve. I have a question here. If the euro economy is bad and the DAX stock are booming, I am confused. Well, Solomon, you don't need to be confused because yes, the eurozone economy is performing poorly, but the DAX and the CAC which is the German and the French stock markets, are rallying for one reason. and one reason only. And that is all the money and the cheap money that the central banks are putting into the market. All of the quantitative easing. What they're doing is they're putting the money into the hands of banks and investors who are then recycling it back into the stock market. So that is why stock markets can rally, even though we are seeing the Eurozone economies perform so poorly. So this is just a little graph from the Financial Times that I pulled, and it just shows you how, indeed, you're right, Solomon. The Eurozone economy is deteriorating, and this is moving into it's moving from the boom mark to the bust mark in the PMI, which is consistent with the 0.3 to 0.5% contraction in Eurozone GDP growth for the first quarter. And one of the questions that we have again is that it makes it difficult. Yes, I understand it makes it very difficult to interpret what this means to interpret the impact of fundamental data on the Eurodollar. And you're absolutely right. And that's why it's really important to have, someone as your guide to help you understand what is more important. Is it the easy money flows or is it the weak data? If we had not had, Bernanke speaking today, and he had, basically consistently, been saying to us, yes, the U.S. economy is improving, and then we start to get, a lot of weak Eurozone data, that would basically, make weak Eurozone data overshadow the rally in the CAC and the DAX. But, that takes a little bit of practice in terms of following fundamental developments to really understand. And that's really my job to help you guys do that, as well as, other fundamental analysts that you may be reading. So, one of the big event risks is that we've got a ECOFIN meeting this Saturday and Sunday, and that is something that could resurrect the uncertainty that we have in the Eurozone right now. Because as you see, the Eurodollar is performing very nicely this morning. It's trading at 133.22, and this rally could be sustained if we don't have any bad news from the Eurozone. But one of the bad news that we could get is if the European finance ministers show any reluctance in terms of working together, because one of the big topics at this weekend's ECOFIN meeting is going to be beefing up that firewall. If they don't beef up that European firewall, then we're in trouble, because Spain and Italy are still hotbeds of risk right now. And if they don't beef up that firewall, we could be in a situation where Spain and Italy won't have enough funding in order to avoid any type of crisis. So if they do show willingness to beef up the firewall by more than investors expect, that could compound the rally in the Eurodollar. So there will be some comments coming out before the ECOFIN meeting. I will listen to them very closely, because that will help us determine whether the Eurodollar continues to rally. Correlations that our Eurodollar, us as Eurodollar traders need to pay attention to, because this will help people such as Solomon understand what's moving currency flows. This is a little chart from Bloomberg. The white line is the S&P 500. Sorry, the white line is the Eurodollar. The orange line is the S&P 500. And what I want to draw your attention to is that this chart here goes all the way back to 2007. And what you'll notice is that for the most part, the orange line and the white line pretty much move in a similar direction. But what we saw is that this year, there was a huge divergence between how the Eurodollar moves and how stocks move. So given that there's a strong correlation between how the Eurodollar move and how stocks move for the past 5 years, even though we had a little break in the correlation between how the Eurodollar moves and the S&P 500 moves for the past 3 months, in the long term, what matters the most to the Eurodollar is how stocks are performing. Because the way stocks are performing is indicative of the overall market's appetite for risk. And that is why today you're seeing the Eurodollar rally as U.S. stocks rally, because at the end of the day, that is probably the most important correlation for the Eurodollar. So if I wake up one day and I think, where will the Eurodollar go today? One of the most important questions I should ask myself is where do I think stocks are going to go today? Where do I think risk appetite is going to go today? And to push that question, make that question even simpler, you should ask yourself, do I think that investors are going to be optimistic today, or do I think they're going to be pessimistic? If they're going to be optimistic today, then there's a better chance than not that the euro dollar is going to rally. And if they're going to be pessimistic, there's a better chance than not that the euro dollar is going to sell off. A quick question here. They're all booming at the expense of Australian stock markets, which is badly underperforming them all. Well, P, as CMC said, and thank you for answering the question for me, Australia is much more sensitive to China than other parts of the world. And that is why, you're seeing that Australia, it's not participating in the rally as much as some of the other stock markets. What would happen in regards to the euro if the ECOFIN meeting that they choose to delay if they're going to increase the firewall or not? If they choose to delay, that's probably going to be more negative than positive for the euro. And yes, euro dollar's got a little bit of correlation to gold, but the big correlation is a correlation to risk appetite. So this second chart here shows you the relationship between the euro dollar, which is the orange line, and Spanish 10-year bond yield. And so this is something that people have been watching really, really closely. And this is a chart that goes from December 2011 to present. And this is the kind of thing where it goes in and out in terms of its importance to the euro dollar. If Spanish yields are just kind of steady or they're falling, then it doesn't really impact the euro dollar all that much. Only when Spanish bond yields soar does it pose a risk for the euro dollar. So good news in terms of Spanish bond yields is neutral for the euro dollar, but any spike higher in the Spanish bond yield is very bearish for the euro dollar. So you can watch Spanish bond yield yourself quite easily on like Bloomberg.com. They've got a markets tab which has the movement in Spanish bond yield. If you're just kind of following what people are talking about in general, you'll catch it on Twitter, or you'll catch it on just kind of Market Watch and any sort of big website that provides that information to you. And it is very, very important because this is where the greatest risk for the euro is, which is the return of the European sovereign debt crisis. This is another chart of the euro dollar and the 5-year Spanish credit default swap spread. The white line is the euro dollar, the orange line is Spanish credit default swap spread. You see a reverse correlation here, which is that when the euro dollar when the Spanish CDS price falls, it tends to be positive for the euro, and when it rises, it tends to be negative for the euro. So that's just kind of emphasizes the importance of watching these Spanish and Italian bond yields and CDS spreads every single day, even if it's checking it just in the morning. Usually, CNBC or Bloomberg or any of the major news media will be talking about it, because that will give you a good sense of the bias of how the euro dollar could trade to begin with. So what you need to know about trading the euro, but before I answer this, I think I have just a couple quick questions here. Will euro pull back in the short term meaningfully or more likely to march higher? Well, right now, unless we have some sudden dovishness from ECB or bad news economic data, I think that what you're going to see is that the dovishness of the Federal Reserve is usually going to last for a couple of days, because what you have to realize is that investors have to have the opportunity to adjust their interest rate expectations. They went from no QE to possibility of more QE. And usually this adjustment is not a one-day adjustment, like a 1 or 2 day adjustment. So at the end of the day, I think that we could see a little bit more of a rally in the euro dollar. And if you follow my double Bollinger Bands that I talk about quite often, we do have a nice little momentum in the euro dollar that could push us into an uptrend zone, which would lead to the possibility of more gains. So what's the percentage I give to fundamentals and technicals? Every single trade I take incorporates both fundamentals and technicals. I'll talk a little bit more about that as we get, just actually very quickly when we're going to shift over to the trading component of things. So what else do you need to know about trading the euro? Number one, there's a lot of intraday volatility in the euro, and that actually creates, the possibility for opportunity. Because when you have a lot of intraday volatility, there's opportunity to join the trend at good levels if we're given that. Of course, intraday volatility could also mean that you get stopped out more easily if your stops aren't tight enough. It's not just the anti-dollar trade. For the most part, it is the anti-dollar trade and also a risk trade. But when we have big, shocking news in terms of Eurozone economic data or big spikes in Italian and Spanish bond yields, that it also makes a Euro trade or a European outlook trade. So for the most part, to sum it up, what I would say is that when it comes to trading the Euro, it's usually, I would say, 70% about risk appetite and about how the markets feel in general, about, either the possibility of more stimulus or the possibility of, better economic data around the world. But occasionally we'll have spikes that come from Europe, or bad news that come from Europe in the form of, spikes in Spanish and Italian bond yields and more sovereign debt risk. And that's when Europe's problems will come back to the forefront. And deflation is always very important for the ECB, so we always have the risk of oil. So that's what Draghi watches carefully right now, because the German PPI numbers didn't show too much of an increase. He's not too worried. But this week we have German CPI, so we'll be watching that quite carefully to see if that filters into German CPI. So if you only take one thing away from what I've talked about in terms of the fundamental outlook, or the outlook for the euro dollar, and all of the factors that are impacting the euro dollar currently and will impact the euro dollar going forward, it is that fundamentals matter. You cannot trade currencies using technicals blindly, because fundamentals are always going to be important in terms of providing the catalyst for trade. I mean, just look at today. Euro dollar was kind of, wasn't seeing too much action until we had Bernanke open up his mouth and say maybe more quantitative policy is necessary. And if you did not know that Bernanke was going to talk today, or you did not care about fundamentals, you would have missed this trade, or you've been really hurt by, his comments. So fundamentals matter. And that's why I encourage you to follow me on Twitter at Kathy Lien FX, because I'm always tweeting about what is happening and all the things that you should know in terms of fundamentals. The key to trading well is combining fundamentals with technicals. So what I would like to do is share with you a euro trading strategy, and then talk a little bit about how we combine fundamentals and technicals at BK. Wow. So what I'm going to do right now is I'm going to flip to my chart. This is just going to take a second. So give me a second. Let me just readjust my chart. One second. Just give me 1 second. So let's just pull up a euro chart here. Alright. Okay, where's my hot comment? Give me 1 second. Alright, so I think that you should be able to see my euro dollar chart right now. So what I'm going to do is I'm going to talk a little bit about strategy that allows you to participate and to find opportunities to join the overall trend in the market. And the reason for that is because fundamentals matter. And fundamentals determine the overall trend in a market. So I'm a strong believer that the best opportunities is following the momentum in the market and following the trend, because trends in the FX market can last for days, weeks, months, sometimes even years. And to fight the trend, therefore, is much more difficult than to join the trend. And you can join the trend on a short-term basis. You can join the trend on a longer-term basis. But for the purpose of illustrations, what we're going to look at is we're going to look at the 4-hour chart in the euro dollar. So let me just flip over to my 4-hour chart. Actually, let's actually lay on the indicators here first. So I'm going to minimize my hotcom box so it doesn't block my screen, so I won't be able to see your questions while I'm setting up my chart. So this strategy is called the value hunter strategy. And what it uses is 2 moving averages and stochastics. So the first moving average that it uses is the 125 simple moving average. And then it also uses the 150 simple moving average. And I'll go back to my hotcom in a second just to refresh my screen in case any of you, for whatever reason, cannot see the chart. So I've got my 125 and my 150 simple moving average here. Then I'm going to add on stochastics. Okay, so we all know that moving averages help us determine the general trend of the currency pair, and the stochastics determines whether we are in overbought or oversold territory. So that's basically what we're going to play off of. We're going to play off of the get different interval here. 240. So let's go to our 4-hour chart. Alright, so the way this works is that we're going to be looking for opportunities to join the trend. So the blue line here is a 125 simple moving average. The red line is the 150 simple moving average. So what we're going to do is we're only going to buy when a currency pair is oversold if it is trading above the 125 simple moving average. And we're going to use the 150 simple moving average to stop. We're only going to sell the euro dollar if it is overbought, and if stochastics moves into overbought territory, and it is below the 125-day simple moving average, and we're going to use the 150-day simple moving average as a stop. So let me just move my chart over so that the moving average can be built a little longer. Alright, so let's look at some examples. So in the case here, stochastics is oversold, so we don't buy the stochastics because the currency pair is trading below the moving average. Here, we see that stochastics has moved into overbought territory, and the currency pair is trading below the moving average. So you would take this trade, but in this case, you would have stopped out. But you know, I always like to show winners as well as losers. So let's take a look at some other examples of possible trades. So there's no trades here, but here are some good examples. Here we see that stochastics has moved from the mid-level down to oversold, and in this case we would have probably gone long the euro dollar at around 130.85 with a stop below the red line, which is the 150 simple moving average. And then you can see that, you know, it rose to a high of 133.20. So we would have entered somewhere around, you know, 130.85. It rose as high as 133.20, With the risk reward, I tend to like to trade with 1 times risk reward with a trailing stop, but you can also use a 2 times risk reward, or you can wait till stochastic rises back above 80 to get out. So in this case, if we went long here and we waited for it to rise above 80, we would have probably gotten out somewhere around here. Let me just make sure everyone can see my chart in hot comp. All right, not slow stochastics, just regular. I like to use the regular stochastics because it's a little faster, but you know, it doesn't deteriorate too much if you use slow stochastics. Do you ever use this for 5-minute intervals? I think it's too choppy for 5 minutes. How do you determine your target? My target is up to you. I mean, that's where risk management comes in. I would start with 1-to-1 risk reward and trail the stop. You could also use 2 times risk reward, or you can use the stochastic and wait for stochastics to cross above 80. So let's look at another example here. Right before this, we also have an example here where it went into oversold. We probably would have gone long around 130.50, and if you use the methodology of exiting just for simplicity purposes, when it goes above 80, you would have exited somewhere around 132. So these are overbought signals here. We wouldn't trade them because the currency pair is trading above the moving average. Here's another example here. We see that the euro dollar has the stochastics has moved into overbought, so we have sold around here, which is 128.25, stop above the orange line. And if you waited for stochastics to move into oversold territory to get out, then you would have gotten out somewhere around here, around 126.50. So once again, here's another example here. Here you were probably sold at around 128, and waited for stochastics to go down to oversold, gotten out around 127. So it's a pretty good strategy that I like to identify points of joining the trend at value, which is why I call it the value hunter. And usually these trends are caused by, bigger, broader fundamental stories. And, by looking for opportunities to join the trend at value, it helps you stay within the overall fundamental story while also benefiting from entering, not buying the low and selling the high, or fading the overall dominant trend in the market. So why do I use the 125 or 150? I've done a lot of testing on this, and I felt that 125, 150 is best. It doesn't just work on the 4-hour chart. It also works in the daily chart, but it produces very few trades in the daily chart. So I didn't want to show you examples from months back, but I also like to use it on the daily chart. And does this strategy work on other pairs? It does, but I think it works particularly well in the euro dollar. So if you'll just bear with me for a couple of minutes, I just want to share with you a little bit about what we do at BK. At BKForex Advisors, which is a service that I run with Boris, we offer trading signals. Every single day we have 1 to 2 trades based upon, in the euro dollar specifically. So we only trade the euro dollar in our BK flow trades. Every day we offer 1 to 2 intraday trades. And these are momentum-based trades, and the average tippage is about 30 pips. You can look at our trade results, and you can see, how we've performed. And it's all based upon riding the momentum in the euro dollar. And we always, send our clients, alerts to place their orders a couple hours in advance. So you usually do have an opportunity to lay your orders down. It's not an at-market order. And so, a lot of clients like this type of trading. We also offer swing trades, which can be in any currency pair, not just the euro dollar, 1 to 2 trades a week. And every single day we have, we produce calendar calls, which are 8 to 12 ideas based upon economic data that's going to be released. We are a CPA with NSA audited results. So if you just simply click on the trade results button, if you simply click on the trade results button at BKForex.com, you will see all of our results, which are audited by the NFA. And when we send out alerts, we get something like this. This was last week. This is a snapshot of Boris's iPhone. This is what it looks like. We hand-hold you throughout the trade. We tell you if we're staying in the trade overnight. We tell you where we're laying out the orders. We tell you whether our stops and targets have been hit. So you're not trading alone. Our motto at BK is don't trade alone, and so we try to provide you with as much updates as possible while we're in the trade. And once again, we are a CTA with NFA audit results, so these are not just out of the blue. And this gives you a snapshot of our BK intraday flow trades. This doesn't include today's trade, which we banked another 33 pips on. Just so you know, we practice what we call high probability trading. So we risk more than we seek to make, but we seek to have a accuracy rate of between 65 to 75%, so that we're consistently generating more good trades than bad trades. So as a result, if you miss one of our trades, it's no big deal. It's not as if some of the other strategies that are based upon better risk reward. If you miss the good trade, then you would have been left with nothing but a series of bad trades. Because with some other trading strategies like Elliott Wave or Gartley or so forth, you're waiting for the big winner. You're taking lots of little losers until you get the big winner. But what happens if you're sick on the day that you have the big winner? What happens if you had to work and you couldn't be at your computer? That's why we at BK don't believe in high profit trading. We believe in high probability trading, where we look for a lot more winners, a lot more consistent winners than losers. And every trading signal combines fundamentals and technicals. And so we don't trade blind. We don't just go for a algo or technical trading strategy. This is kind of a snapshot of our recent BK swing trades, which you can also see if you just click on the trade results tab at BKForex.com. And this also is based upon our biases for how a currency will move based upon economic data. And we predict where we think, what type of surprise we'll have in economic data every single day. So since we've been running the service and since the NFA has been auditing our results, I've audited our results going back to 2008. We've never had a losing year. Past results are obviously not indicative of future performance, but we're quite proud of our performance, and this is kind of our performance on a quarterly basis for our swing trades. And every trade alert comes with the reason comes with basically telling you what we will trade, which currency pair, why we will trade the currency pair. So we give you a reason for why we're coming into the trade. It comes with stops and limits, which are predetermined, and we give you updates along the way. And we send you those updates and all that information via email, our website, as well as on your phones via text message or SMS. And we also have a private Twitter page, which is only available to our subscribers, where we post all of this information as well. So I encourage you all to take a look at our website, BKForex.com. We've got a $59 trial going on right now. So if you are not familiar with what we do, it's an inexpensive way to give us a test and take a look at how we've been performing. For those of you that are already BK members, we thank you so much for being BK members, and we hope you continue to enjoy our service. So now I would just kind of like to open up the floor for any questions. Len, how much of your trading is based on your Momo method? We combine a lot of different ideas into our trading, and you'll see how, and then incorporate some of the trading strategies that we have shown in previous sessions, such as the Momo. Hi, Kathy. Is it true that euro is now used as a funding currency, and thus the divergence compared to the Aussie? I wouldn't necessarily say that is true, Kiwi. The euro has become a cheaper funding currency, and so therefore it's cheaper to, it's not very expensive to sell euros and buy Aussie, but I think that it would be a very risky endeavor to look at the euro as a funding currency, particularly with so much risk in Australia right now caused by slower Australian growth, as well as slower Chinese growth, as well as just kind of weakness we have in the domestic economy. So I would not necessarily look at it that way. I would be very, very cautious of doing so. CMC, what do you think of the dollar Swiss lately? Well, I mean, dollar Swiss is pretty weak, and there's a very good reason for it to be weak, particularly after today's comments from Bernanke. So I think that if we think that the euro dollar is going to continue to rise, we can't help but think that the dollar Swiss is going to continue to fall. Any other questions? Okay, so like I said, I thank you all so much for joining me today, and I hope you learned about a little about trading the euro, and I hope you enjoyed this presentation. And please, if you don't follow me already on Twitter, please do so at Kathy Lien FX, because I produce a lot of different commentary that I update people on throughout the course of the day.